Hello, everyone, and welcome. This is the third webinar out of four, and I'm happy that Ryan is here with us because he did a great job the first two webinars. And I'm happy that you attendees are here with us because you're taking a great step towards increasing your chances of succeeding in futures trading by expanding your education. So without too much noise, I'm going to have Ryan get started, and we will answer questions along the way and at the end. This webinar is being recorded. And again, Ryan Gorman of the CME Group, welcome, and please go ahead and take the stage.
Thank you so much, Ilan. It's a pleasure to be back. We've done a couple different sessions here so far over the past, couple weeks, couple months. Basically, we wanted this to be a linear progression through the futures markets. And so, we kind of jumped into it. What are futures? What are options on futures? How does the CME play a role in all of this? And the from there, we kind of did technical analysis, fundamental analysis. We jumped into spread trading. We touched slightly on options. Today, we're going to get into options. We're going to be talking, kind of across the board, what options are from the very basics to a little bit more advanced, some of the growth that we've seen from retail users in a lot of different options markets over the last year. It's really, really been incredible. And one of the messages I always like to get across is a lot of the traders I talk to, at different events, through different webinars. A lot of the questions I get is, hey, I'm trading options on Apple, on QQQ, on SPY, on these equities, these stocks. What do I need to know about futures? And a lot of what I'm going to tell you about today is if you understand options, an option is an option essentially, and that bridge, that gap between options on equities and options on futures is smaller than you might think. And if you understand optionality, getting into the futures market, can be something very, very beneficial for you. So I'm going to share my screen real quick here. And it looks like I need permission to share my screen, Alon, if you can get
You
that for me.
you have a great track record, and I'm going to enable you to share the screen right now.
Thank you.
Just takes me a minute usually. Let me see how I do
Yeah,
that.
no problem.
Am I allowed to multi-appeal? Make host. Okay. Make. Okay. I think we should be good now. If you want to give it another shot.
Got it. Got it. Got it. All right.
Yep, I can see your screen.
Perfect. Now I don't want to share it. I want a slideshow. All right. You can see the screen. It looks good.
Yeah.
Excellent. All righty. So let's get into it. So yeah, so basically, we're going to be talking about today, we're going to be talking about options on futures. And the kind of came up with the title, The Options Edge, precisely defining risk in futures markets. As we kind of get into it, there's a lot that goes into options, and we're not going to touch every part, but we're going to talk about a lot of different things within options and some of the goals that I want to kind of get across. First of all, defining your risk with precision, understanding how futures options offer unparalleled control over potential losses just using the futures markets in general. Going beyond speculation, explore the strategic role of options in hedging and enhancing futures options. But overall, at the end of the day here, what I hope some key takeaways are going to be are being able to distinguish between futures and futures options. It's actually interesting. I got this question not too long ago at an event I was speaking at. Someone asked me, what's the difference between a futures contract and an option? And inherently, I know it, but when I went to describe it, it was more difficult than I thought, which kind of set me back and made me kind of go back into it a little bit. But outside of that, learning protective strategies using puts and calls for your futures positions, discovering advanced spread strategies, along with grasping the impact of premium and expiration. So there's going to be a handful of things we dive into, and then we'll get into some questions at the end, definitely. But again, I'm really excited to jump into this. Thanks again, Alon, for letting me come on here and share, everything I know here about the options markets. But
Of,
let's jump right into it.
of
So
course.
yeah, absolutely. Thank you. So yeah, just overall, I get this question a lot, also why options, and one of the things is we're seeing tremendous growth from a retail point of view, looking at all of our options across the board from retail traders. Just year over year volume, this was through May of this year, but it's gone up even increasingly from this. We're seeing growth across the board in our options markets, not just our futures, but our options. And the standouts there, metals, a 90%, 97% growth in just options amongst retail specific traders. Foreign exchange 62%, interest rates 50. Even, energy equity indices and ags are on the rise. And it's a continued track we're seeing. We're seeing a lot of traders, what they do is they try to get into the market. The typical path is to go into the equities market because that's what most people have a basic understanding of. And they learn quickly that they'd rather look at the options than just buying outright stocks because of the leverage that you can get. And then from there, that knowledge is growing and saying, I want to get into the futures market and utilize options there. And one of the outside of just the growth, one of the main things I talked about at the beginning was understanding what these are. And the main message we've been, talking to people about is an option is an option. So many of the option strategies, and a lot of the math, your Greeks, your deltas, your gammas, your vegas, all of that on the equity side is going to translate from options on stocks right over to options on futures. Really, the key difference just comes in the underlying. So, instead of an option on Apple, you're trading an option on the S&P 500 or the Russell or gold or silver, whatever it may be. Options on futures are margined in the same capital efficient span margin that the futures contracts have. So that capital efficiency you get that we've spoken about in previous webinars, talking about the capital efficiencies of using futures over equities, that is transferable as well. And you're going to get that with the options on futures. With that, like futures, futures are traded nearly around the clock 5 days a week. So, think about all the times if you're actively trading equities or equity options that, we have a big earnings report that comes out after the bell. It's 7 a.m., 6 a.m., 8 a.m. report that comes out, and you can't do much with your equity portfolio. But with the futures markets, you can have access to not only the futures markets, but our options markets as well. So getting into the basics here, futures versus futures options. So again, I got this question and it kind of, shook my brain a little bit because inherently I understand what options are. I've traded them for a long time. I understand what futures are, traded them as well, but actually explaining it to somebody who really didn't understand it was a challenge for me. So it's an important concept to really nail down. So a futures contract is an obligation to buy or sell an asset at a set price on a future date. It's high leverage, it can have unlimited risk and reward potential, upside and downside, and requires margin to hold. So that we understand. We've talked about that. It's kind of the difference between stocks and futures. Futures options contracts are slightly different. They are the right, but not the obligation to buy a call or to sell a put, a futures contract at a specific strike price before expiration. When you think about options, the maximum loss for an option buyer is limited to the premium paid. So what that means is if you buy a call option on the S&P 500, your maximum risk on that trade is the cost you paid for that option because you didn't just go in and buy the contract, you bought the right, not the obligation to that contract. So you bought the right to exercise. So buying, if you buy a call or you buy a put, right there, that's going to be your total max risk on that trade. What this does is it offers flexibility and defined risk. When you're just buying a futures contract, if you think, hey, I think gold is going to go up over the next month and a half. A lot of times when traders have an opinion like that, buying a futures contract might not be in your best interest. One reason is it might go up and you might be correct. The futures contract went up, but there might be a few days, maybe the 3 days after you bought that futures contract, that gold could drop significantly. And if you're just in the futures contract and your account is a little bit undercapitalized, you could be running into margin issues. You could need to clean up your position, anything like that. So there is that risk of, hey, this could just go down right off the bat. And then I'm out of my position and gold still might finish up after a month and a half, but I wasn't able to capitalize on it. With the option, you can buy an option at a strike price that's out above where the price is currently at a month and a half down the road. And you don't have to worry about the day-to-day swings because you know, hey, I paid X amount of dollars for this option. I don't have to stare at it all day every day. I can check up on my position and see how it's looking, but I don't have to sweat worrying about, big margin calls or anything like that because you know what your max risk is on that trade. So that flexibility, being able to define your risk. Also, just going in and buying that option, even if that market goes against you, if it does and you're holding a futures contract go against you, you don't have room to really negotiate. The market is telling you where to get out of your position. With options, you have that flexibility to decide where or if you want to actually execute that position. So it's really important to understand, if you have an opinion on a market, there are other ways than just going in and, hey, we talked about doing your technical and fundamental analysis, looking at spreads. There's ways where you can look at options outside of that that can just help you kind of define your risk and help you be a little bit more flexible in the timing of your trade. So one of the things we'll talk about here, we'll talk about some of the very common ways to utilize options with futures. And I think that this is really important because I think that the dual method of using both and then this other two strategies we'll talk about are very effective ways to utilize our markets. So protective puts. So your futures insurance policy. So basically, we'll run through a scenario. So say you're long a futures position. Say you've bought an ES futures contract. We'll say MES, for example. So you buy a micro E-mini S&P expecting the market to rise. So you're long this futures position. We talked about this example earlier, but a sudden market downturn could lead to significant losses. That's kind of your overall risk. If the market just rips lower on you, you're going to be in a little bit of water and you're going to need to do something. It'll be an action point for that trade. So a solution would be you can buy a put option with that same underlying futures contract. So essentially what you're doing is you buy a futures contract and then you can buy a put option. So what you're doing there is you are limiting some of the upside that you can make. If the futures contract just runs higher and higher and higher, you're going to lose money on that put option up to the point that you paid for it. So you're giving up a little bit of upside by paying for it, but if you think about it as an insurance policy, that's kind of what it acts like because you believe that the market's going to go up, but if it goes down, you want to be protected and you're willing to put a little bit more capital into the trade in order to ensure it's not a complete blowout and you're going to live to fight another day and be able to trade in the markets the next day, week, month, year, whatever the time frame might be. So the put gives you the right to sell the futures contract at a specified price. If the market falls below your strike, the put gains value, offsetting the loss in the futures contract. Your maximum loss on the overall position is capped at the futures entry price minus that strike price on the put, plus the premium you paid for that put also. So it's one of the ways that we talk a lot about being able to understand what futures are, being able to understand what options are, and using both of them to create positions. We talked about using spreads to help define your risk. This is another great way to do it, is going into the market and saying, hey, I believe this is going to go up. Maybe I'm not 100% certain, but I don't want to miss out on a potential move here based on a thesis you may have. That's when you come in, you say, okay, I'm going to go long this micro E-mini S&P contract. I'm also going to buy a put with it, which is going to cost me a little bit extra. But I know that if this market just rips down on me and cascades lower, I'm at least going to be protected and be able to make up the losses on the futures contract with that put option. Protective calls are very similar as well. So this is essentially hedging short futures positions. So say you're short crude oil futures, for example, expecting prices in the near term to fall. And crude oil's been falling and falling and falling over the last couple, weeks. So this is, pretty nice little setup here. But the risk again is that a sudden market surge could lead to significant losses. So, if there's a huge supply issue with crude oil and the market just decides to shoot higher, you're going to be stuck. Even if in the long term that comes back for you, you're going to be in a little bit of water with that just futures position on alone. So that solution would be to buy a call option on that same underlying futures contract. That call, again, gives you the right to buy the futures contract at a specific price. If that market rises above your call strike, the call gains value, offsetting that short futures. And again, the maximum loss on the overall position is capped at the futures entry price plus the call strike plus the premium paid for the call. So again, this is just kind of the inverse of that. So in any futures position you take, it's essentially you're saying, hey, I believe this is going to happen. I believe the market's going to go up or down, but I'm not willing to, risk my portfolio on this. I'm not willing to risk more than this amount. And that's where you can do a calculation, figure out what you're willing to risk, figure out the appropriate strike price to have the call or have the put on, and you're protected. You don't have to worry about, a tweet or a news headline about the government reopening that your position is going to be wiped out. At the very least, you have protection to a certain point. Bull spreads. This is very common. It's one of the most common um, types of trades that I used to do that I see a lot of traders doing. Um, it's a great way to establish an opinion in the market without taking on so much risk. And we're going to go through a chart later that kind of describes, how a lot of these different, who's using what types of spreads and what markets. But a bull call spread, a vertical spread, you're profiting from moderate rises. So the market view is you are moderately bullish on a futures contract, expecting it to rise, but you want to limit your cost and you want to limit your risk. This is again I think that we have a lot of things going on in the market right now. Maybe you believe by the end of the year the E-mini S&P is going to go a little bit higher. But you don't want to bet your whole bank on it because there's so much uncertainty in the market right now with the government still being shut down. There's tariff situations. There's a lot of uncertainty, global tensions, you name it. So the construction of this, an example using calls. So buying a call option at a lower strike price and then selling one at a higher strike price. So think about the E-mini S&P. So you can buy, I'll just throw out random numbers, but you could buy something like buy the December, E-mini S&P at 3,000, and then you're going to sell the December E-mini S&P at 3,050. Now, those are totally made up numbers. It's a complete hypothetical. I just promise this is not trading advice, but just to put some numbers to it so you can understand. Basically, what you're doing there is the risk reward profile is the maximum profit is limited to the difference in the strike prices minus the net premium that you paid for that. So when you look at any option, it's going to have a price. So basically, what you're doing is you're buying one and you're selling another. And then that difference is going to be the price you pay for that bull spread. So whatever that price is going to be super important to understand. And then the maximum loss is limited to the net premium that you made. A lot of the benefits with this, again, this is something where I want to establish a position, but I'm not 100% dialed into it. I have uncertainty, but I don't want to miss a move if it happens. It reduces the upfront cost compared to buying just a naked call, a call all by itself. Also, what it does, it limits your overall risk and it limits your overall profit because they're sort of acting against each other. But if you believe in the near term, this market's going to rise or it's going to in this case rise, this is a great way to do it. It's very common that you'll see, traders might have, a, a bullish call spread going out 3 months, and you can have that position established, understanding, okay, I am long the E-mini S&P market, going out 3 months, 6 months, whatever it might be. And then a lot of times what you'll see is traders will come in as that position is gaining or losing value. You can come in with micro futures and maybe trade around it. That's a very common thing that we'll see is, maybe you have a longer term position using a bull call spread, establishing your bias to go higher in the near and long term. But, very short term, there might be things in the market that you see. And because that bull call spread was limited in cost and limited in risk, you have still capital in your account that you can utilize to try and profit or speculate on short term moves in that market. So it's a very, very effective way to establish a position. And kind of just the reverse, the opposite of that is going to be your bear spreads. So your bear put spreads. So what this is doing is the inverse. It's capitalizing on moderate declines. So basically, you're moderately bearish on the futures contract, expecting prices to fall. But again, you don't want to limit cost and risk. The construction of this is very similar. It's just simply the opposite. So you're buying a put option at a higher strike price, and then you sell a put option at a lower strike price. So what this does is it helps you kind of just establish that position. And again, the benefit of this is it reduces your upfront cost compared to buying just a straight up naked put, defining both the profit and the loss. So what you might see is the one strike price, might be 6, the one might be 10. So, you'll meet somewhere in the middle, and that's what you'll pay for that overall cost. So it really, really can reduce your overall costs. The one thing that I hear from traders that they don't like about it is it limits my upside. What I always say to that is something that I've been preaching, to everybody that's been listening to these webinars over the last 3 sessions is your goal in trading shouldn't be, hey, I want to make a big trade 1 or 2 times and go hit the beach, lay down, relax, and retire the rest of my life. That's not what trading is. Some people get lucky, that's fine, but the risk that they put up was substantial for that luck. Being able to have a process and being able to build out strategies like a bull call spread or a bear put spread gives you that opportunity to have a position. You can still have extra capital left over in your account because this position costs you a little bit less. You can trade around positions. You can look at other markets potentially where you can layer in some of these strategies, or that you can use some micro contracts to trade around your overall position. But these are probably the two most common, the bull call spread and the bear put spread, also known as vertical spreads, that we see. So you believe a market's going to go up or down, and this is a way that you want to utilize the options markets to manage that risk. So this is a really, really nice chart just to take a look at. Um, there's a ton of different, ways you can use options and different strategies, but you can kind of see it's layered out by, 6 asset classes here, crypto excluded being the seventh. But you can see right off the top, um, looking at vertical spreads, so those bull call spreads and bear put spreads. Across the board, they are very highly traded. And in grand total, 43% of the retail options strategies that we see here at CME come from vertical spreads. And you can see it across asset classes. Some asset classes have a little bit different. Like you'll see generic spreads, are right there as well. You'll see like foreign exchange, for example, straddles are super common for foreign exchange markets. Across the board, there's a ton of different ways. You have your generic spreads, you have your strangles, your ratios, your iron condors, all the way down to a lot of these, which pretty much no retail traders are trading, but they're available. And there's a ton of different ways that you can look at these. You can utilize the margin a lot differently. So I always recommend to people a lot of trading platforms, they'll have things where you can select a certain strategy. You can select vertical spread, you can select, iron condor, and you can just practice building them out. You don't have to place the trade. Make sure you understand it before you do. But being able to build these out, understand where the strike prices are, understand the cost, because some of these option strategies can be a little bit, there's a bunch of different legs to it. There might be 3 or 4 different sides to it, and it might be tough overall to understand the actual price. But understanding that all of these strategies, they all come down to a price. It'll cost you something to purchase that option strategy, and you have to know what that cost is in order to be able to price up any part of that position. So I always like to show this just as a general, hey, take a look here. These are very common. But again, that vertical spread, the bull call spread and the bear spread. All right. Am I still sharing my screen here, Alon?
No, I think you got disconnected for a second. That's why I just came back on, unmuted myself. You're
Yeah.
gonna need to share it again.
Got it. How does it look?
There you go. Perfect.
Okay, perfect. All righty. Yeah, and then we'll move on a little bit here to premium and expiration, the key drivers of option value. So premium. So again, premium is going to be what the price of that option actually is. Um, and there's a couple things that go into it. So intrinsic value. how much the option is in the money, if any. If you ever are pulling up, wanting to look at options, if you look at an options chain, there will always be a middle point, and that is the separation, that's at the money. Then there's in the money and out of the money, depending on how the platform looks. That should be moving constantly. If you have a position on, it's really, really important to understand where you are in regards to at the money, in the money, or out of the money as you kind of approach the expiration of that. This has changed a lot recently because there are now options. I mean, I can go on right now and buy an option that'll expire at the close today. I can buy an option that'll expire, in an hour. You can buy options that expire very, very soon. So it's really, really important to understand how close or how far you are to being in, at, or out of the money. Extrinsic value is time value. So the value attributed to the time remaining until expiration and implied volatility. Time is something that people really almost sometimes forget about when it comes to optionality. But buying an option, that's why a lot of these, zero DTE options have become so popular. If you buy a zero DTE option in the morning and the market right away goes in your favor, up or down, whatever direction you picked, it happens so quickly, the velocity of that move is going to drive the value of that option higher quicker. Now, what happens sometimes people may get confused. They may buy an option that expires the same day at, right at the open, 8:30 a.m. Central Time here in Chicago. If that thing goes against you, or if that just kind of stays flat until, 2, 3 o'clock, 2:30, and then starts to rise, the time value plays a big factor. So it's really important to understand that. And when you go longer term, you can kind of see how that works. And then there's factors influencing premium, such as the underlying price, the strike price, again, the time to expiration, what the implied volatility is, and your overall interest rate environment. So, if you start seeing vast, moves in the underlying, say you're trading crude oil options. If crude oil like had a day like today where it's just flying lower, you're going to start seeing those strikes moving very quickly. And, that underlying price moving a lot is having a big effect on that. The implied volatility, again, understanding, what does the volatility look like now? And, what does the implied look like as well? And kind of how are those two, are they coming together? Are they separating? Again, and then expiration. So time decay, which can be also talked about as theta. So as an option approaches its expiration date, its extrinsic or time value erodes, kind of as I mentioned. This theta decay accelerates as expiration nears, especially for at the money options. It's crucial for option buyers and option sellers. So if it's either working against you or it's working for you. But again, this is one of those things where, if you're buying an option that's 6 months down the road compared to an option that expires in the same day, there's big differences there in that time decay. The time decay and that theta decay erodes very, very quickly in those very shorter term options. So it's going to be really important to kind of understand, be able to track, and a lot of the platforms will allow you to do that. What all these Greeks mean, what the theta means on your actual position. So understanding premium and expiration, again, that's kind of the mechanics of how these options actually work. I can't tell you how many times I've talked to people who say, my option actually finished pretty close to, my strike price, but it gained no value. And it always comes down to theta or time decay. Alrighty. So some of the key takeaways: mastering risk with futures options. Again, my main point that I'm trying to get across, I mean, the country and the world at this point, to all traders is, listen, an option is an option. You can use options the same way you use them for equities. You just have to understand the underlying, and some of the multipliers on options are a little bit different. Futures options provide defined risk and significant flexibility for managing market exposure. Puts and calls are effective tools for hedging against futures positions. Again, this is one of the more common strategies we see. If someone's trading, it's not rare, I would say, but oftentimes people won't just say, "Oh, I buy and sell futures," or "I buy and sell micro futures." It's, I do, covered calls, or I do, covered puts, which basically just means I'm getting long or short the futures contract, and then I'm taking that and I'm protecting it with either buying a call or buying a put, just so I don't have to worry about the risk. And usually, how that comes about is somebody is just buying or selling futures contracts and they get killed in the overnight session one day with a position, or they stepped away from their computer for an hour and they get killed on the position. And they learn that. My goal is to help people learn that the easy way through this and not the hard way through losing your hard earned dollars. You don't want to be forced into having to use a certain strategy because the one you used wasn't very risk defined and opened you up to a lot of potential losses. Bull and bear spreads allow for precise risk reward profiles based on your market outlook. So again, you can pick and choose, how far out you want to go. How big of a spread difference do you want in your strike prices? How much risk do you want to take? You can 100% mess around, start clicking around on different strike prices and figure out your cost. And you might just say, I want to buy the cheapest spread I can buy using these options. Or, I'm willing to pay a little bit more for these options. I'm going to spread them a little bit or keep them really tight. And I want to express this opinion for 6 months out from now. And then a deep understanding of premium and expiration is vital for successful trading. We talked about this. Always define your risk before entering a trade. It's going to be super, super important. One thing, too, that I think we mentioned, but I want to hint at it again is when you're thinking about futures options versus equity options, that key difference in the underlying is so, so important. When people think about equity options, I think it's pretty common that I'll hear, yeah, I trade options on, Apple, for example. If you pull up an option chain for Apple and you look at all the prices, you might see a strike price that says it's $2, 2.80. Inherently, you're thinking right off the bat, that's $280. I hear that all the time. I just know what the cost is because with equities and with stocks, it's just 100 shares. That's the value. So it's whatever the strike price is times 100 shares. That's what the option represents for equities. For futures, that key difference is going to be that multiplier. For futures contracts, every single asset class, every single market, and every single size has a different one. For example, the E-mini NASDAQ multiplier is 20. So you take the option price and multiply it by 20. The micro E-mini NASDAQ is 2. So you take that strike price of the E-mini NASDAQ and you multiply it by 2 to get the value of the option. So again, understanding that an option is an option, if you can understand how to take what you know from equities, what you know about optionality in general, and you can take that, apply it to futures, you can take advantage of the capital efficiencies. You can take advantage of the very liquid markets that we offer, some of the most liquid in the world. You can take advantage of nearly 24/7 trading. So you can have access to your portfolio, your market, your trades, even when the traditional market hours are over. It'll help you. I'm really encouraging people to take a look at this. It can really, really help you define your overall risk. It can help you, not have to worry about your positions all day, not be staring at your screen glued to it all day, making sure that nothing bad happens. And again, outside of that, a big risk management strategy that I see often is, oh, I'll just throw stops in. Well, anybody that's a seasoned trader that's had stops in overnight knows that sometimes a market can blow right through your stop. But if you use options, options are just going to gain value, against your position. So you don't have to worry about, oh, my stop got blown right through on some huge flash move in the market. It eliminates that for you. So again, I highly recommend, at the very least, if you want to learn more about this, you could try it in simulated trading, get used to the feel of it, learn more about options overall. CME has unbelievable options courses, lessons, quizzes that you can take that'll just sharpen your skills. I say this all the time, but I'll keep saying it. I traded futures and options on futures for 4 years before I started working here at the exchange. My first month at the exchange, all I did was go through the CME courses, mainly on options, because man, if you're not paying attention for some time or you don't sharpen up those skills, you'll forget, and it'll something will get away from you. And understanding how beneficial they can be will really, really help, and it'll take you to the next level. A lot of traders that are trading futures are already taking that step to trading at the next level using the inherent leverage that our markets offer from equities. Adding options to that will only increase your overall portfolio. It'll increase your precision and it can help you with everything that you're doing on the trading side.
And as a broker, I'm gonna just jump in there. What we see here on our side is that Again, it's not scientific, but traders, clients who utilize multiple assets or let's say multiple strategies, meaning not just day trading. There might be day trading. They might also do some spread and swing trading. They might be, utilizing options. They might have some trades where they are long the asset and they are actually writing options like collecting premium. There's a lot of different facets to this equation, and it's a very tough game. It's a very, very tough business to be a successful futures trader. The percentage is very low. I mean, I'm not going to tell anybody otherwise because that's the facts. But the
Yep.
ones that make it, the first thing is they survive. They're able to survive for a certain amount of time so they can learn as much and utilize as many different skills and tools that are available depending on the market, on their outlook, on the situation, et cetera, et cetera. And just really quick, here's an option chain. This is today's option on the mini S&P. And this is what Ryan has been speaking about. You get the option chain. This is the line right now, the 68.70 that's considered in the money, but the 68.65 pretty soon might be the one in the money. You get the calls, you get the puts. Those are 0 day, meaning there's a day expiring today. And you can see that if you wanted to go long, just for the heck of it, you can just you can pay 3 points, which is $150, and be long from 68.70 or 68.73 once you add the premium, and you don't have to use a stop because that's your maximum risk. And that is just
Yep.
a very, very basic example. Secondly, you wanna educate yourself, go on our website. And on our website, courtesy of the CME, there's a education part where there's trading courses. And some of those trading courses are talking about options. But I'm going to extend a hand or an offer to you. We have three what I call very advanced brokers when it comes to options that probably can teach you more than any course can teach you. And we wrote a few articles here about those options. It's also under the education, and you can also reach us via phone, via email. And I recommend you scroll through it. You can read about some option strategies, about selling options, spreads, and much more. Before I think, Ryan, I want to see if there's any questions. And right now, I do not see any questions yet. Um, and that is more than okay. The option arena is can be very advanced or very basic. It depends on you and your level of knowledge. I highly recommend understand basic plus and see if this is something good for you. I mean, with the volatility we have nowadays, there's quote unquote trades that what we call where you can get in the market utilizing the market's money. Doesn't mean that it's not risk free,
Yep.
but you can create spreads where you sell an option, I mean, buy an option and sell two options that are way out of the money, and the spread will be for even money, and many other examples. At any rate, we are here available for you. We want to thank Ryan for his time and knowledge and his insight and the CME group. Feel free to come visit us, call us. There's a phone number right here, and you'll find that our brokers definitely know options and futures.
Absolutely. Yeah. And the last session we're going to do, the very next one, it's going to take everything we've talked about. So get your technicals, your fundamentals, your spreads, your options. Now what? We've taught you everything about these markets, not everything, but as much as we can. Now what do you do? How do you actually try and go apply this? How do you utilize risk management? So, anybody that's in here, make sure, you're going to want to tune in for that last one. We'll send out some information, I'm sure, about it, but very excited to, get going on that next one. So looking forward to doing that.
Much appreciated. Thank you again, Ryan. Thanks, everybody. Have a good trading the rest of your week and a good week period. And we look forward to seeing you on the next one. So for now, goodbye.
Thank you. Bye.